Well, greetings, my beloved clients and friends. So, this topic is going to be a little bit different. And it came up in a conversation with a client. Ironically, I brought it up. And so, what I want to talk about today is how I get paid. And there's a saying, something like, follow the money and you'll find out what's really going on. So, if you find out how I get paid, maybe you'll find out what's really going on. So, in a nutshell, here's how I get paid. On the last trading day of the month, at the close, they take a snapshot of the balances of all the accounts. And I get paid a percentage of the balance at the close of business on the last trading day. So, for example, last Friday was the last trading day of the month. So, for March, I get paid on the balance on the closing balance of February 28th or Friday. I think it was the 28th. And that's also the balance that's on your statement when you get your monthly statement. And that balance will fluctuate. I mean, this month is a perfect example. February 20th, the markets were at an all-time high. And then there was this pretty decent pullback the last few trading days of the month. And that pullback, the difference if I got paid on the balances on February 20th versus February 28th was several $1,000s. And I think that's why I was talking about it, because clients sometimes are affected by volatility. But my point was, so am I. And I'm affected even more by the volatility, right? You see it on paper or on your statement, but it's very real to me. It affects my paycheck in a very real way. So, as a result of that, do I manage your money differently? And the answer is generally no. One, I'm a fiduciary, and I'm obligated to put your interest first. So because what could I do to mitigate that? I could hedge your accounts, or I could, sell out before the month, and I could do certain things to try to mitigate that volatility, or invest you less aggressively, per se. But is that really in your best interest? Or would I be putting my interests first? And I would say to both questions, no. No, it's not in your best interest. And no, it's not even putting my interest first. Because I'm considering my long-term interest. And so I want to tell you a story about something that I experienced early on in my career that had a huge impact on my philosophy or my approach or my thought process behind managing other people's money. And so I started in the business in 91. I was at a small firm, and then in 93 I went to work at Wells Fargo. And at the time at Wells Fargo, ATMs had already been around for probably about a decade, and so people were increasingly using the ATM to take money rather than walking into the branch. But for the most part, anything besides pulling out walking money, people largely still came into the bank. So there was a lot of traffic. And if you're around at that time, you probably remember you walk into the bank and there's like this table, and in that table there's some like little compartments with deposit slips, and there's different ones. They had like a checking deposit slip if you wanted to deposit to your checking, a savings deposit slip if you wanted to deposit to your savings. They also had withdrawal slips, and they also had at Wells Fargo at that time in the early to mid 90s, they had a IRA deposit slip, because the IRA had been around and it was gaining popularity as an investment vehicle, and people at the time could put $2,000 a year into the IRA, and so the bank was really promoting those type of accounts. And the deposit slip was kind of interesting, and you could choose how you wanted the money invested in your IRA right on the deposit slip. You could put it into the savings option, which maybe at the time was paying 3%, or a money market option, which was probably paying about 4%, or different CDs, 6 months, 12 months, a year, 5 years, at various interest rates. And they had like a poster up for the rates of the day on CDs. But interestingly, you could also, they had about 4 different options that you could invest in a mutual fund that invested in stocks and bonds. And you could just pick the one you want, check it, and say, okay, I want to put $500 into my IRA, and I want it to go to this mutual fund. And I think there were 4. There might have been more. There was an aggressive growth mutual fund, a growth and income, an asset allocation, and a bond fund. Okay, and this was in the mid-90s when the market was doing really good. And I remember that at that time, the aggressive growth fund, if you pulled up a fact sheet and said, well, how's this fund done in the last 5 years or whatever? And it was averaging like 20% a year. The growth and income fund was also a stock-based fund, but it was a little bit more conservative stocks, if you will. And it was averaging probably about 15%, 15%. And then they had the asset allocation fund, which was a combination of stocks and bonds. It was about 60% stocks, 40% bonds. And it was averaging about 13, 14%. And then they had the bond fund, which was a diversified bond fund, averaging like 6. And so as the financial advisor at the branch, my job was to gather investment assets. So one of the things I would do was to call on these bank clients that had these IRAs, whether it was in savings or CDs or mutual funds. I'd call them because they were self-managed, right? So I'd call them and say, hey, I'm the financial advisor at the branch. I see you have a decent balance in your IRA. I'm here to help you manage that. And if you work with me, there's a lot more options than just what's on that deposit slip. And I could help you, manage that and grow it for you for your retirement, and help you diversify a little bit better. So I talked to hundreds of people. We sat down and call them, and we discussed this, and we bring those assets under my management. And an interesting thing that I observed, I talked to people that had invested in the asset allocation fund, the one that was combination stocks and bonds that was averaging about 13, 14% in a great market, loved it. They loved that fund. And a lot of them had been putting money into that thing for years, 5 years, 8 years, 10 years, and they just loved it. People that had invested in the aggressive growth fund, on the other hand, the one that had been averaging about 20%, hated it. They hated that fund. And I talked to people that had been in it, and they saw their money go down. They took it out, and they didn't really want to talk about investing in mutual funds or stocks because they had a bad experience, right? And they're like, oh man, I tried investing in mutual funds. I'm sticking to CDs. I had a bad experience. I tried that aggressive growth fund and I lost money, right? And the people that were still in it, they didn't like it. It was just too volatile of a ride. And when they say they lost money, I'm scratching my head. I'm thinking, this thing's averaging 20% a year. How did you lose money? And I think maybe some of them did if they held it because it was very volatile. If they held it for a very short time, they saw one bad day or one bad monthly statement and they got out. But I think there's a good chunk of them that maybe they put in 2,000, it shot up to 3,000, and then the next month it was down to 2,500, and they're like, man, I lost $500, and they pulled out. And so did they lose money? You could say that, but if they put in 2,000, they pulled out 2,500, that's like a 25% gain, you know? But it didn't feel good, right? They lost the money. And so that stuck with me, that if I wanted to have clients that were happy, happier clients had that asset allocation fund. Unhappy clients had that aggressive growth fund. Even though if they would have stuck with it, they would have been averaging 20% a year. Even with even if the average of 20% was their experience, the volatility was also their experience, and they were unhappy. So now I get paid. I don't get paid when I open an account. I don't get commission. I'm a registered investment advisor. I'm not allowed to earn a commission. I only get paid each month on the balance. So if the balance goes up, I get paid more. If the balance goes down, I get paid less. And if the balance goes away because you left, because you're unhappy, that affects my income, right? So I get paid to keep you for a long period of time. Really, that's and if your money could grow over time, my business will grow, my income will grow over time. And quite frankly, I've been in this business for a while now, and I really do zero marketing. My business grows to the extent that I grow your money. And so that's what I spend my time and my efforts trying to do, to grow your money steadily. I'm not dependent on needing new business. If the same business I have, my client's money is growing at 10%, my business is growing at 10%. My client's money is growing at 15%, my business is growing at 15%. And so that's what I spend my time on, staying in touch with my clients and helping them have a comfort level when it does get uncomfortable, and trying to grow that money, studying how I could, and where are the opportunities to grow that, and not just grow it period, but grow it at a tolerable rate that they could stomach, not too much volatility. Okay, because in my experience, again, volatility isn't a way to grow your business. So if I compare those two styles, that asset allocation fund, now if generally a 60-40 portfolio these days is not going to average 13%, because back in the 90s the bond side was getting 6 to 7%. You know, that's not been the case anymore. Interest rates have come way down, and the stocks were doing really good, as we saw. That aggressive growth fund was 20%. So when you put that mix together, you had a pretty decent return. But really, in general, with the asset allocation type of portfolio, you should probably expect maybe 9 to 10% returns in the market that we're in on average. So when I think about my strategy for how I want to manage and grow my business, and I'll talk extensively about the rule of 72, which is a shorthand way to determine the rate at which money will double. Basically what the rule 72 says is, if the time times the rate, when it equals 72, that'll tell you the rate at which it will double. For example, if you're making 10% returns, your money will double in 7.2 years. If you're making 7.2% returns, your money will double in 10 years, and so on and so forth. So if I'm trying to grow my business, and let's say and I don't want any volatility, I could put your money into something that was making 3.6% and it would double once in 20 years. Now, you wouldn't suffer much volatility with that type of investment, but you wouldn't experience much growth either. And if my income is paid on your growing balance, I wouldn't see much growth in my business either. And I would have to be a marketing machine because that money isn't growing. I'd have to spend more time marketing than taking care of you. And, the type of accounts that do that, I don't really need to take care of the clients that much because it's just like a fixed annuity or something. But is that really what's in the best interest of my clients? If you started with $1 million and 20 years later it doubled once and now you have 2 million, is that going to make for a wonderful retirement? Well, when you started with $1 million already, maybe it's a decent retirement. But what if you could get 7% and in a period of 20 years it could double twice, right? At 7.2%, it will double twice. So that would be the difference in a 20-year $1 million investment from going to 2 million to doubling twice to 4 million. Now that's a big difference, right? Doubling twice versus doubling once over a 20-year period. That would be a big difference in what I got paid, and it would be a big difference in the lifestyle that you would enjoy in retirement. Because what if you started with $500,000 and instead of retiring with $1 million, you retired with $2 million? That's a big difference in the lifestyle that you're going to enjoy for retirement. Now, at that rate, I'd have to have some type of real conservative portfolio with a little bit of equities, and I'd have to educate you a little bit and hold your hand a little bit. But what if I could double it 3 times over 20 years? So it would have to grow, it'd have to double like every 6.7 years, right? So that would require a rate of return of about 11, between 10 and 11% to get 3 doubles. Now, that would be helpful to my business, and it would be helpful to your retirement to shoot for like about 11% returns, right? Because then if you started with, let's say, $500,000, it doubled to 1 million, to 2 million, to 4 million. That's a pretty nice retirement, right? Or even if you started with 250, it doubled to $500,000, then 1, then 2. That's a huge difference. Then I'm really adding value, because if you were just in a savings account and it only doubled once, or if you were just in some really conservative target date fund like in your 401k, it only doubled twice, versus working with me and doubling 3 times, it would make a huge difference in your retirement. And it would make a huge difference in the rate at which my business was growing, right? And the income that I was earning from that business, and whether I needed to devote myself to marketing or to managing your money, right? And communicating with you regularly and educating you on the market. What would it take? I'm crossing this river, so what would it take to get it to double 4 times, right? Double every 5 years. That would be about a 14% return. If we could average a 14% return, it would actually double 4 times. Now that's a huge difference, right? If you started with $1 million, it doubled to 2, to 4. It doubled once to 2 million, to 4 million, to 8 million, to 16. That is a substantial retirement. Even if you only started with $500,000, it doubled once to 1, to 2, to 4, to 8. Even if you started with 250, you went to 5, to 1, to 2, to 4, right? Now I'm really having an impact on the lifestyle that you could enjoy in your retirement. And I'm really able to focus all my attention on managing the relationship and managing the investments to get you those 14% returns. And since we've started tracking the returns of our investments using this, what's following the GIPS regulations for reporting performance, which we've been doing for about 8 years, which is that way we could report what our returns have been, because there's real strict guidelines. We've been getting close to 20%. Now, we've gotten lucky and we weren't shooting for 20. We just had a couple big wins that helped us, but our target is about 14, 15. Our goal is to try to get you to double every 5 years. Okay. Now let me ask you another question. What if we could get it to double 5 times? Would that make a huge difference in your retirement? Yes, right? That would be like a 250 going from 250 to 500, 1 million, 2 million, 4 million, 8 million. But to do that would require like an 18% return net of my fee. So now we're getting into aggressive growth territory. We're getting into too much volatility territory. We're getting into unhappy client territory. And, we're getting to client turnover where it's not in my opinion, it wouldn't be a sustainable business model. We've happened to gotten lucky and had gotten better than the 14 we're shooting for. But if I've been shooting for 18, I'd have to take way too much risk. And it's definitely not certain that I could do it. Even 14, it's not guaranteed that I'm going to do it, but there's a method and an approach that we take that has proven to get those type of returns. No guarantee for the future, but there's a method to our madness, and we believe that we could do that. So we don't shoot for that, and that's why. That's why we don't shoot for that, but we do shoot for the doubling every 5 years on average, and we believe that that is a sweet spot where it's a good business model for us, and it'll make a big impact for our clients. And so to get you to that level, I think comparing that asset allocation fund that I talked about, that these people with no financial advisor were happy doing for many years, versus the aggressive growth fund that had the higher returns but miserable customers. I'm trying to shoot for maybe a little bit more than the asset allocation fund. And if I could, I'm not trying to get to the aggressive growth fund because I know that's too risky to the relationship with my clients. But if I could hold their hand and stay in touch with them and let them know that what I know and how I do it and what I do, and a comfort, and be there when the market does get volatile, to talk them through it, and to trust me, I think we get a little bit better than that. We could take a little bit more risk than that 60-40, get a little bit better returns, and shoot for like a double every 5 years on average. So what is that gonna look like over a 20-year period, right? If we're averaging 14% and it's doubling. Well, we know, we've already talked in detail what the end number will look like for doubles. But what about year by year and month by month and day by day? I'll tell you, we should expect, and we have experienced, about 2 really rough, let's call it what it is, bad years out of those 20. Out of those 20, there have been, and there probably will be on average, 2 very uncomfortable years. where I see my income go down, you see your balances go down. But even with those 2 years thrown in, we're still going to average. If we should be able to average that 14%, which will give us the 4 doubles in 20 years. Okay, but you gotta get through it. And sometimes it happens early on in your first or second year with me. Sometimes like you had a nice run and then it comes, So you don't ever know when it's gonna happen, but we gotta get through that one rough year. And probably of those 20 years, another 4 to 6 that were really quite lackluster. Maybe you're down a little bit, maybe you didn't make much. And maybe you're like, man, looking at what that did this year, I would have been better off in a savings account. I would have been better off in a 3% CD. There will probably be about 4 to 6 years like that on average out of the 20. Even with those 2 terrible years thrown in and 4 to 6 lackluster years, those other 12 will carry us to our goal. Because when we say average is 14%, that doesn't mean most of the time it's going to be around 14. In a good year it'll be 16 or 17, in a bad year it'll be 10 or 11. That's what people think. But no, what it means is it's going to average 14, but in a good year it might be 50 or 80. But don't expect a bunch of those, but just 1 or 2 is really going to make a difference. And in a bad year, it might be minus 20. Okay, so there's some range there, right, to get that. But if we're a long-term investor, and I could help you get through, one thing is to tone down the expectations after the good year, because people think like, oh man, do it again, Jonathan. And we're not going to always have those phenomenal years. Like the last 2 years have been like plus 20, and that's above average. So, I don't expect a great year this year. And, so far, I think it's slightly negative 2 months in. But I'm not worried about it because we have an approach, and a lot of our clients have been with us a long time. We have some that are second and third generation, so they've gotten used to it to trust me, and we'll get you through this. And on average, you stick with me 20 years, which like a lot of clients had. We should try to shoot for a double every 5 years or so, and make a really big difference in your retirement. So that's why I stay in touch with you and try to, share with you what we're doing, and check your pulse at least once a quarter, and send out a video at least a few times a month to just let you know that we're here, that we're aware of the volatility and what we're doing in our approach, and to keep that long-term focus. Because if we do that, I think you'll be happy over the long term, and my business will prosper. Obviously, priority number one is your retirement. That's my fiduciary obligation. But follow the money, and there's going to be some. It cannot help but have some influence in how I think about managing other people's money. And so there it is. I pulled the curtain back to let you know really my motivation and how I get paid, and how it affects how I manage, how I think about managing your money. And so, the other thing is, my approach isn't for everybody, and that's how come everybody is not my client. If you're willing to go on that kind of ride and experience, some unpleasant quarterly reviews, I tell my clients, on average, when I call you once a quarter, 3 of those calls are going to be good and 1 will be bad. And I was telling a client that. She goes, yeah, I know, Jonathan, but fortunately the last few have been pretty good. I said, well, don't get too excited, because the more good ones we have in a row, there's probably a bad one around the corner. And that's just the unavoidable nature of the markets. But if you're able to deal with that and not be paralyzed by fear, and to subject yourself to 3% returns and one double in 20 years, that's a very um, unexciting retirement, you know, versus if you're willing to really understand that the nature of business is to grow, and good business has proven to be able to do it over a long period of time. You could open yourself up to seeing your monies, double several times over your investing lifetime and make a huge difference. They asked Albert Einstein, what's the most powerful force in the universe? He said compound interest. So to use that in your favor, that's our goal. That's why we have these talks. I went a little bit long because this is an important topic that I really don't discuss in detail much. So I went a little bit longer than normal. And I thank you for those of you that have already made it all the way to the end. And I hope you guys have a great day. And as always, feel free to reach out if you have any questions or comments. And we'll be in touch. All right. Have a great day.